people look back on 2023 as a remarkable year for the stock market, as it defied so many bearish shibboleths. Think about how many pros insisted that the inverted yield curve automatically meant we were doomed to recession. This rigid adherence to Wall Street orthodoxy, coupled with high short-term interest rates, put many investors on the fence when they should have been all in the stock market, plain and simple. What were the most obvious stocks to own? Well, the most glaring are the best performers in Dow Jones Industrial Average, if only because they're household names that anybody can get their head around. You want obvious? These are the masters of the obvious, starting with the top 5. Stick around after the break for the bottom 5. Let's get right to it. Last year, the number 1 performer in Dow was Salesforce with a 98% gain, and I know this one was gettable because we got it for the charitable trust, and I screamed it from the rooftops for years on end. In fact, many of the top performers were investing club names. I'm not to brag, but lots of last year's top performers were long-standing holdings for the trust, either because we believed in management or the product, or simply their ability to put up great numbers. And I'm proud of that, okay? I mean, I've made mistakes, but I'm proud of this. What made Salesforce a somewhat obvious get? Because CEO Mark Benioff sided with 5 activist firms, including Elliott Management, Starboard Value, and ValueAct, agreeing that it was finally time to emphasize profits over revenue growth. Mark had been fantastic at creating value for shareholders until November 2021, when all things software fell off a cliff. Salesforce plunged from 311 to 126 at its lows. It was tough going through that period, but we persevered for the charitable trust simply because we believed Benioff would eventually declare a year of efficiency, not unlike what Mark Zuckerberg did at Meta Platforms. However, we didn't count on how readily Benioff welcomed the more agitated investors, especially Elliott, which offered some incredibly constructive criticism. Now, look, you know I've become a huge fan of Elliott after discovering again and again that they do tons of quality homework, even as not many entrenched CEOs accept their conclusions. No executive wants some hedge fund coming in and telling them what to do, even when that hedge fund is right. Almost no one thought Benioff would embrace these so-called brigands, but he did the opposite and lean into their plans. Why was Salesforce easier to spot than most winners? Because Benioff made it clear he was willing to make major changes to boost profitability. He put through big changes to the board of directors and issued multiple statements agreeing with critiques from activists like Elliott. He said they'd find a better, more rigorous way to sell their excellent products with fewer salespeople per account. Great gross margins would go way up, and it worked. Sales didn't go down. Profits went all the way higher. If only more executives embraced the rigorous presentations from these smart activist firms, we'd have a lot better stocks. All that said, I expect cloud stocks like Salesforce to get a little less love this year because the Fed engineered a soft landing. And that means more money's going to go rotate into the cyclicals that need an improving economy to put up great earnings, and less from companies that do well without a strong economy. The second Dow success story is Intel, up 90%. It's about the relentless enthusiasm CEO Pat Gelsinger brought to a formerly downtrodden group of engineers. Gelsinger managed to bring his product line up to date, positioning the company for the return to PC growth, which is terrific, and I believe in that. He also got Intel into the high-performance computing business with some really great products and great align. Is Intel back? All right, let's just say that it's more competitive versus AMD than it's been in a couple of years. And it doesn't have cell phone exposure, which was the anchor to leeward for many of the semiconductor stocks this year. Hey, you know what? Well done, Pat. Third best performer is another obvious pick, and it's Microsoft. Here's a company that embraced AI in a successful way when they bought a big chunk of OpenAI, Sam Altman's company. You know them as the guys behind ChatGPT. With this expertise, Microsoft was able to commercialize AI by launching its Copilot product, bringing it to the market incredibly quickly. This was an instant success story, and it allowed Microsoft's legendary CFO, Amy Hood, to crow about the initial sales numbers. She's an extremely circumspect figure, I've known her for ages. So her enthusiasm for Copilot on its conference call and its reception helped fuel the stock's giant sprint right into the finish of 2023. This is just nothing but net here. However, if you own Microsoft and you've got a big gain here, again, it's time to trim. Bring the register on. It's part of your position. Bulls make money. Bears make money. And hogs, well, I'll tell you what happens to hogs. They get slaughtered. That's why I'm saying do not be greedy. It's okay. I'm blessing some trimming here. The fourth best performer, Apple, was viewed with the usual skepticism for most of the year because Apple's shown very little revenue growth over a sustained period. The critics were out in force against the greatest tech story of all time. This stock has a legion of haters, even though long-term they keep getting it wrong. What are the haters missing? Hey, how could Apple rally 48% and yet still be regarded as some sort of mediocre enterprise? Simple. The naysayers are looking at only one standard, the growth of the iPhone business, but they're ignoring the rapidly growing service revenue stream from people who buy those phones. Although an analyst today issued a sell recommendation on Apple that included comments about suboptimal service revenue growth. Look, the bears also refuse to recognize Apple's future prospects are about a lot more than China. There are so many growth markets now. It's just that they're considered lesser developed countries like Brazil, the Philippines, Indonesia, Turkey, eventually India. The bears assume that these places will only ever produce a piecemeal group of customers. Stock market, again, knows better. That said, Apple's now selling for nearly 29 times this year's earnings estimates. That's too high. It's hard for me to justify. Even as I tell you to own Apple, don't trade it. If you want to trim. The rally's been so strong, it might not be sustainable for now. Again, you never want to be a pig, especially when the short-term party could be over for high multiple stocks coming into 2024. Finally, the fifth biggest winner in the Dow was Boeing, up almost 37%. I have fallen on my sword multiple times on this one. At the suggestion of my colleague David Faber, who zeroed in on how I could stick by a management team that seemingly couldn't shoot straight. Ultimately, I threw in the towel on Boeing for the Travel Trust when we should have been buying more. Hey, listen, I gave myself some credit here for the Magnificent Seven. I screwed up Boeing. Where did I go wrong? In the end, I fell prey to something pretty obvious. It didn't matter how long it took Boeing to fix its operational issues because we have a worldwide plane shortage and there are only 2 commercial aircraft companies on Earth. And that operate at least at a true scale. If you're an airline, you can't get away from them. Southwest Airlines complained about Boeing's shoddy track record on Squawk on the Street to me. And then they ordered 108 planes from Boeing because they had nowhere place to go. Do not get me wrong, Boeing's track record was truly terrible, hence why we did sell for the trust. But it wasn't bad enough for them to lose orders to Airbus, which is the only metric that matters. Lose some orders, but not the book. In the end, there was huge demand for planes thanks to relentless thirst for flying post-COVID, for more than Airbus could build on its own. With Boeing, you had to focus on the big picture and ignore the details, even if they were real negative, and it was tough to ignore. Here's the bottom line. Yes, the winners seem obvious. They always do by hindsight. But some just needed foresight to shine. And it didn't even take much foresight to identify the Dow's biggest success stories last year. They were right in front of you. Mad Money is back after the break.
Coming up, you've heard about the best. Now let's do the rest. The dogs of the Dow from the year gone by, reviewed. Next.